Welcome back to another episode of Profitless on Purpose, a nonprofit accounting podcast from an accountant's perspective. I'm one of your hosts, AJ Wheeler, and with me as always is Mark Palardy.
Hey, everyone.
Got a great episode this week. Have a couple articles to discuss. The first one is single audit clarity, which probably is an oxymoron like military intelligence, but, because it's never clear. But we'll talk about, essentially what a single audit is, kind of like the baseline rules if you're subject to one or if you think you might be subject to one, and what to look out for if you're getting grants from governmental or state agencies that have federal funds attached to them. Our second article is actually why you should ignore Charity Navigator, how their ratings probably aren't the best to go off of if you're donating your money. We'll talk about what the author means and kind of our take on what Charity Navigator does rating nonprofits on a 1 to 4 star scale. And then our last article of the week is impact investing at 15, a look at 3 field perspectives. So impact investing, what is it? What the critiques of it are, and kind of the 3 schools of thought of how impact investing has changed over the last 15 years when it was brought into vogue. And then our question of the week this week is a nonprofit startup that wants to know about their Treasury position, what they're supposed to do, what kind of the baseline requirements of a treasurer at a small nonprofit are, especially a startup nonprofit. We'll talk about all that and more this week on the Profitless on Purpose podcast. To start us off, Mark's got our first article. Why don't you take it away?
Hey, thanks, AJ. Yeah, our first article today is called Single Audit Clarity Provided Related to Pandemic Relief Programs. So this one's a little inside baseball, a little wonky accounting. We don't usually talk about regulations that are coming out, but this is specifically interesting to me for nonprofits. So first, I want to start with a little bit of a primer as to what a single audit is. That term is thrown around a lot. I've heard a lot of people say, what is a single audit? Well, any nonprofit or governmental organization that has federal expenditures in excess of $750,000 for the year is required to get what's called a single audit. And this single audit basically looks at the financial statements for any of these federal awards and sees how you've managed this grant of money. Like it just wants to make sure that you followed all of the rules that are set forth. There's a guide called the Uniform Guidance for the Single Audit. And I think that's called an UG. Our resident expert in this field is actually AJ, and he's going to talk about what some of these changes are. But it's important to know that if you're a nonprofit that's growing and you start getting to a size where you're applying for federal grants and they're giving you more than $750,000 a year, you're going to be subject to these single audits. So AJ, you want to take it away from here?
Yeah. So single audits, boy, I used to audit when I was in public accounting. I did a lot of single audits, and it's funny. It's not just nonprofits that the Single Audit Act covers. If you're a for-profit business and you're receiving governmental grants, like say I used to audit like a medical company that did R&D that got funding through National Science. Is it NIH? Anyway, they would expend more than $750,000, or back then it was $500,000. They would spend more than that in a year, so that we would have to audit this for-profit company for a single audit. And I think the big thing is to note is if you have governmental audits, so this includes like state funds coming in, you need to read those grant agreements thoroughly and check to see if there's a CFDA number, which they do this all the time. They change CFDA number to assistance provided or something. Anyway, it's a 2-digit with a dot and 3 digits after it, and it tells you which agency this money is coming from. And so just because you have, let's say you have $1 million in governmental grants in 1 year, but you receive like $500,000 worth of funding at the end of the year, and you're just starting that program, it's not so much awarded money, it's actually expenses related to governmental funding. So it's kind of weird. Like it's not, if you just get $750,000 in 1 year, you're not automatically subject to a single audit. You have to expend more than $750,000 in federal program money. So it's a weird kind of wonky thing. And the rules of single audit or having a single audit done is, like Mark said, under the Uniform Grant Guidance, which is the noise you make if you are actually needing a single audit, because it's ugh, because they are kind of a pain in the butt. Just off the top, they're really specific. What happens is an audit firm comes in, they're going to do a vanilla audit or like a financial statement audit on your organization, as well as a secondary audit that actually addresses your federal expenditures. And they're going to dig down and they're going to look to make sure you have controls in place and you took money when you were supposed to, and you followed all the rules. The participants in your program were the correct ones, and you were just handing out federal dollars to anybody. So it's a long-winded way of saying you really need to be on top of this, because it can sneak up on you pretty quick. If you're a small organization and you're bringing in state dollars, often those state dollars are like funneled through the federal government. So they get money from the federal government and then they pass it on to you. And lo and behold, you only have state grants, and you have over $750,000 of federal expenditures. And all of a sudden you're subject to this really intense audit. So keys, I think, for our listeners, without getting too much into the weeds about this stuff, is read your grant agreements. Make sure you have somebody that understands what your grant agreements are spelling out for you, and have somebody identify if you have federal funds in your grant, and make sure you're tracking that within your accounting system or outside of it to understand if you're going to be subject to one of these things. There's kind of some gamesmanship if you're close to that line that you can play. And like I said, not expending more than $749,000.99 would keep you under that threshold. But I mean, that's really a moot point if you're trying to serve a community or kind of push these programs out that have federal dollars associated with it. So I think first and foremost, understanding your grants and understanding your notice of awards, especially when it's coming from a governmental agency. The other thing to note is, understanding the requirements under those grants. If you have participants in a program or something like that, understanding the bare minimum for people to meet and have that documented. Participants. So this may cross over to people that are on the program side and are administering these programs to make sure that they understand the requirements around it, because it's not just testing the financial numbers around those grants, it's testing the requirements that are within the grants. So like if you have a needs-based kind of thing, let's say low-income housing dollars that are going out, or something that falls in poverty line kind of, poverty is not just being poor, it's an actual dollar amount that somebody earns per month based on numbers in their area. So like the poverty line in like downtown Los Angeles is much different than like rural Nebraska, where cost of living and amounts of pay or amounts of income are different based on cost of living adjustments across those areas. So that's just one example, but just to make sure that you're upfront and understanding this stuff in the beginning is going to save you a lot of headache on the back end, because a finding on a single audit can be devastating to your funding sources if it gets reported. So, and not to mention, if you have a single audit, it's consider tacking on $5,000 to $10,000 more onto your audit fees every year. So it's expensive. It can be costly if you have findings, and you really want to stay away from that. And you need either a professional in place that understands how to understand those grants and account for them. And you also need to then have a firm that specializes in this kind of audit that does your audit. So if you're getting close to that, I mean, of course, if you have questions about this, you can email the podcast or tweet at the podcast. We'll of course answer it on air. But I would say, that's kind of like surface level of what a single audit is.
Yeah, and just as to put a cap on this, the reason we're bringing up this article is that there's some information that's coming out now and some addendums planned for the future that have to do with the coronavirus relief funds and different programs. So if you have programs that you're out there using, and just have awareness. We're going to link the article down below. We're not going to go into all the details, but anything pandemic related, especially if you've created programs for that, created programs for relief programs, these are going to be affected by some of the new guidance. And I think it's going to help make the reporting easier. So it's easier at the outset if you can start looking at some of that new guidance. AJ, I think you got our next article for us.
I do. This one comes our way from Philanthropy Daily. I picked this one because, well, I'll get into it in a bit here, but it's the title of the article is "Ignore Charity Navigator." So, quick primer on what Charity Navigator was. I think early 2000s this came out, and what it does is it aggregates 990, the informational return that's publicly available. It aggregates those numbers and scores a nonprofit on a 1 to 5 star scale. And it was supposed to provide clarity into the types of organizations if they scored high in a Charity Navigator kind of metric of the 1 to 5 stars, like it's a restaurant. It's supposed to be a good charity to invest your money or to give your money to. And essentially the way Charity Navigator works is, and this part of the article here is, so it takes into account, it says guide your intelligent giving, and it does a rating of this from 0 to 4 stars, and they're based on essentially the IRS tax status, revenue, length of operation, location, public support, fundraising expenses, and administrative expenses. And so the 7 criteria that are there is it's supposed to give you an analyzation of the financial health and accountability and transparency of the organization that it's rating. And so a couple things that the article brings up that maybe Charity Navigator doesn't do a good job of, I guess, disseminating to the masses is that fundraising expense, for example. So they're leveraging these metrics based on how much administrative costs, fundraising costs versus program costs an organization has, and it's rating it. The problem is, well, I don't know if it's so much a problem, but they give certain organizations in an area more leeway for, like, say, administrative costs. So public broadcasting and media is one. Normal, like a good, quote unquote, good organization would have administrative costs under 10%, according to Charity Navigator. Public media gets a pass and can spend up to 35% of fundraising before they get a 0 because use expensive airtime to raise money. So this is actually the fundraising portion of the functional expense. And so, like, kind of gives a few more examples. We'll link the article in the thing. And it makes fundraising kind of an evil sort of, or a bad functional expense item, because it means the more money you're pumping into fundraising to raise more money to help the people that you're doing isn't going to programs. But if you can show a nice return, operators or somebody that's in a nonprofit knows if you're using those fundraising dollars wisely, it's a ROI on that kind of exposure. So the article goes in and kind of shows that, or kind of gets into why Charity Navigator uses these ratings and ranges that may not be applicable, and it kind of plays to a certain market or a certain type of organization to give them more leeway in this kind of area. And so then the other part is program growth and program mission. So it wants you to explain your program mission. It wants to see a year-to-year increase in program and mission spending. And so, I think the author says it thing here, the quarrel is not with the metrics, but with the criterion itself. Charity Navigator rewards organizations that grow and punishes organizations with humble and local goals with a strategic vision to stay a certain size. So any of our listeners that are in the nonprofit space knows once you grow, it means more admin, more expenses, more program staff. It can be, and essentially you're getting more and more like a business and a very like top heavy sort of organization to be able to support the programs that you keep expending on. We all know that the way you grow revenue in a nonprofit is you get more grants, you get more donations, you get more people you run more fundraising events. So those 3 things take time, effort, and to be able to do those, you have to have staff to support it. So I think the last kind of paragraph really sums up how I feel about it. Giving is not about statistics, impact, and expense percentages. Giving it is about advancing a mission you care about. So I think this has changed. In the early 2000s, Charity Navigator was looked at like this, like the app of the future. You could log on to Charity Navigator. Here's a 4-star charity that I can give my money to. And you felt good that somebody kind of told you, did the back end work of uncovering whether or not it was a good charity or not. I think we've waned from that in the 2010s and now the 2020s, where I think we've gotten, I think the philanthropy side of the nation has kind of gotten away from that and are more focused on what an organization does and who it helps. And I think Charity Navigator's kind of fallen out of, the limelight a bit, but people still, if you were, like really heavily invested in this, it's still a metrics out there that gets toted around. So I think, like the author says, you need to give to the organizations that are advancing a mission you care about. And I think, each organization has different expenses and expense ratios in this kind of thing. I think it's a good starting point to look at it, but I would try to understand, at least my take is, I would try to understand an organization and a nonprofit a little more than just reading a Charity Navigator or looking at their 990, because I don't think that's going to give you the full picture. But Mark, I'm sure you have something to say on this. I probably rambled on long enough here. So
no, all good. Yeah, I mean, this was definitely an interesting article. And I think one of the problems with Charity Navigator, right, is, and it's just kind of the nature of the beast, we always look for something that's easy, right? You're looking for something on Yelp. You organize it by highest rated stars, right? So mankind is always looking for the easy solution when they can find it. And if they're looking for a charity, right, they've come into some money or, whatever, they're going to look for the highest rated stars. Or if they're interested in a particular, whatever, a particular type of charity, say a children's charity, they might do a filter on Charity Navigator and try to find the top rated ones. As a result, it's kind of a self-fulfilling prophecy. So you have these organizations that are going to try to game the system because they know what the Charity Navigator matrix looks like. I've worked at an organization where it's like, we got to keep our Charity Navigator 4-star rating. So not that they were lying, but that then the mission and the metrics and the budgets for the year start to kind of revolve around keeping your Charity Navigator 4 stars. And that can be problematic, right? Because then who is serving who, right? Are we at the behest of Charity Navigator trying to bolster up our numbers? And then, and honestly, there are some foundations that use this, right? So they're looking to fund an organization. They're going to check what their Charity Navigator star rating is. So even though it might not be as in vogue for the individual donors anymore, it's still kind of baked into the system, especially with grant giving foundations, et cetera. And I think it's problematic on a larger scale because it's the system we have. And if somebody can, I'm going to get on one of my rants, right? Which my friends think I'm weird about this, but if you think about the website Rotten Tomatoes, right? And everybody's always talking about, oh, is it fresh? Is it rotten? Right? And then you look at, oh, it's 98% fresh. That means it's really a great movie. Well, not necessarily. Rotten Tomatoes looks at a thumbs up or a thumbs down. I might 51% like a movie, and 98% of my reviewers agree I 51% like the movie. And so it gets a 98% fresh rating because 98% of people just marginally liked it. Doesn't make it a perfect or a great movie. It just means it's meh, better than bad. So, looking at that kind of thing, it's totally skews the number. And I think Charity Navigator can fall into the same trap. I know I way off on a tangent on that one, AJ, but it's
got me over here looking at my favorite movies on while you're talking on Rotten Tomatoes. I want you to know Happy Gilmore only got a 65% rating, which is outrageous.
Exactly. I would write a strongly worded letter, AJ. Anyway, so no, I'm with you on this one. And I think, unfortunately it's systemic now. And I don't know if there's a better system to do this. But people want easy answers. I mean, not everybody's going to pull down a 990. Not everyone's going to do the deep dive research. So going with your gut, going with charities you know and can research and can actively be a part of is probably your best bet. But some people don't have the time or the energy to do that. They just are at the year end and they need to donate some money in order to get that tax write-off. So
well, and I think those are really good points. And you brought up, kind of this rating system that's subjective and not objective. I think they try to make it objective, but it's definitely influenced by who's putting this list together. And I would say, our listeners are probably, either in the nonprofit space or nonprofit adjacent, or just, I don't know why they would watch this, but anyway, but I think, doing your due diligence would be like, find an organization that you connect with. It's all about relationships. And as much as we try to get away and we have, apps that'll do this for you and apps that'll do that for you, it's really a relationship. And you want to find a nonprofit to donate to that you connect with. This can help you maybe find one like in your area that would do something that you're interested in, or that's your cause that's close to your heart. But don't just rely on the metrics numbers and on a 990 and a Charity Navigator score. Connect with that nonprofit, maybe volunteer an hour or two and see if what they're doing is, up your alley. Or if you just need to donate money, find one that, like is well known in your neighborhood. If they're in your area and they make an impact, I think you can easily find them. And that means they've, fostered some kind of goodwill and have done good work in the past, and you can probably rest your money giving on that side, or your charity gift on that, hang your hat on that if they're well known, then they've created a reputation for themselves in your area. Or if they're a startup and they're doing something unique, maybe support those guys. But I think every nonprofit strives to do some kind of mission. And I don't think it's a shell game of moving money around like some people like to make it. But Mark, do you have our next article for us?
You bet. This last article today is called Impact Investing at 15, a look at 3 different field perspectives from the Nonprofit Quarterly. And this article kind of dives into this notion of impact investing, which just came into vogue 15 years ago, and looks at kind of 3 different organizations and how they've handled impact investing. And just as a primer, impact investing is the idea of consciously leveraging financial capital to advance social power or to build power in a specific community. And kind of the jury's still out as to whether this is really effective or not. Some investments certainly can advance these goals, but some don't. And so, a lot of investors have divergent goals, different ideas of getting towards that. So these larger foundations that are giving towards impact investing, are they just doing it with whatever is in mind for them towards what that looks like? Or are they doing it with input from the larger community that they're serving? One of these is the Rockefeller Foundation. And at this point, they've given $6.4 billion in impact investing, but they're looking to do even more. And they're wanting to know how to do this in more mission-related fields. So obviously, in the past couple of years, this has grown and grown, and they want to make a real change in, BIPOC, people of color organizations, but they need to continue having serious conversations about what that looks like for those organizations. And, some are saying they are, and some are saying they're not. But this organization, it's the Rockefellers, they believe that an all-inclusive capitalism is the best option to do this through, right? Give people of color businesses to own, et cetera. And then another organization wants to ask if how to give money to the communities impacted without doing any harm. So how can they put money into a community? They're looking at this basically from the other side. How can we invest without doing harm to the community, without tilting the scale too far, but yet giving people the money and the means to do what they want to do? And yet a third one is really more on the pro-justice side and wants to shift the flow of power. So they're using their dollars to help move the concentration of power from those where it has been into areas of where people of color need the money, and they're going basically for systemic change. So you've got this kind of capitalistic point of view, this do no harm point of view, and then this maybe social justice point of view where they really want to change the system from the beginning, from its roots. So how are we going to determine if impact investing is actually being successful when there are so many different metrics, and when there's many different ways this can be looked at? So I thought it was interesting to think about, because I don't have a lot of experience with impact investing, but I do know that there are quite a few foundations and grant makers at this point that are looking to contribute money specifically to these kinds of programs. And it would help as a donor, to see what their missions, what their goals are, not just we want to give to people of color, but what is their underlying philosophy and what they're trying to do with that. And that's where I find the interest here. But AJ, what do you think?
Well, I actually, this article reminded me of one of the most difficult audits I ever performed when I was in public accounting. A little bit of background on what I'm talking about here is, and we mentioned at the beginning of the show, I used to do single audits. So I had a single audit come in, and it was from what's known as like a rotating loan fund. So what happens is government granted this organization that worked with Native Americans that were trying to start their own businesses. So very similar to kind of the investment kind of problem that they're talking about in the article. And what they would do is they would make what they called micro loans to these Native American folks that wanted to start their own business. So like there was a fishing business that was wanting to be started. Somebody needed to buy a boat to be able to do this. Another one was somebody wanted to start like a concrete company, Native American gentleman, and he needed to buy like a truck to haul around the concrete or whatever to do this work. The problem is there was no financial education given to these people that have probably never taken a loan in their life. So the way the loan fund would work is you were to loan the money out. These people were to start their business and they were to pay back that loan with interest. When you got that money back, it was revolving. So now you get it back, you have it in the bank, it earns a small amount of interest, and you loan that money out again, and it's supposed to churn. The problem is that you gave this money to people with terms of like paying it back 2 payments in a year or something like that. And these people had never managed money before. And unfortunately, the reason why we were auditing it was like a 6-year-old like loan fund that had shut down because nobody could pay back the money. They didn't know how to manage the money portion. So you gave this money out, but you didn't provide any kind of financial literacy or planning or any kind of support to these people. You just handed a micro loan to them. So, and it failed, and they tried to like repossess boats. You really did the opposite of what this loan fund was trying to do. You had these people that tried to make the best of what they were looking at, thought they had a solid business plan to do so. But you're talking about somebody that had never, managed money. They're microloans, so it's not like they have an accountant on staff to make them aware of these things. And there was no follow-up done. It was just either given the money, they didn't pay, then you had to repossess something that was, attached to the loan. So, and then you have a nonprofit with like a salmon boat. What the hell are you supposed to do with that? You're not going to get your loan money out of it. So it was very disheartening. And the conclusion that I came to looking at it was that these people weren't provided the financial literacy or the support to be able to make it successful. So I would say, I can see where this, like, you want to invest in something, and much to Mark's kind of point is, like, it's really in vogue right now to have, some kind of diversity, equity, and inclusion package, and what's in your program. These foundations and organizations and investments are salivating to give money to those sorts of programs. Any kind of these, like persons of color run businesses, again, like organizations are really looking to grant that. And I would say that that's awesome. I mean, I think that there needs to be more of that. There needs to be, if somebody doesn't have the kind of background that would enable them to get loans or to start things that they want to do, I think that's an admirable program or grant making that can happen. What I would caution against is just handing out the money without any kind of like follow-up or program in place where people, get this money and, like say it is like a revolving loan fund. They need to have the financial wherewithal to be able to put money away to pay that back, especially if you're having payment terms of like 2 payments to pay back $10,000. I mean, that's hard to do if somebody's, living paycheck to paycheck and didn't have enough money to buy the boat in the first place. So I think having, like the financial literacy, or at least the program to support these people, as well as having money available to be able to lend it to them or invest in it, is crucial. But there needs to be an educational piece that helps these people along, and I think brings them up to speed on this stuff.
Yeah, I agree, AJ. And I think watch this space, because I think impact investing and donations is not going away anytime soon. This is going to be something that we're going to see for a long time to come. And who knows what it'll look like in 5, 10, 15 more years. So yeah, AJ, I think with that, it brings us to our topic of the week.
Yeah, so dig into the mailbag here and answer a question from a viewer. This viewer writes in, needs advice. They're a nonprofit startup and everybody is scared of the Treasury position. Well, I can tell this person that you're not the only one. Even mature nonprofits, everybody's scared of the Treasury position. And so let me read the question here. Okay, so new nonprofit, and they're handing out rules for board members. I assume Treasurer would be intense with an established nonprofit, but with no money coming in yet and a new nonprofit, they want to know what the expectations of a treasurer are at this point. And they have about like $2,000 in raised money, and they're spending some of the savings, personal savings, to get the nonprofit up and running. So they have a bank account and accounting software and showing all the details through this, but they want to know what are the responsibilities for a treasurer, and specifically a treasurer for a startup. But maybe we can even dive in and just kind of give an overview of what a treasurer should do. And I think that may change depending on the size of the nonprofit. I mean, at least that's my personal opinion. But I'll let Mark jump in here first, because I know he has experience as a treasurer on a board, as we all do, and you get roped into this as an accountant from time to time. But yeah, Mark, why don't you give us your experiences with treasury positions in a nonprofit?
Roped in is the word, AJ. Once you start telling people you're an accountant, oh, you want to be a treasurer on my board? I can't even tell you, even coming out of accounting school, you'd have, hey, you have a heartbeat and you know accounting. Let's rope you in, because accounting is intimidating to a lot of people. The common layperson frequently says, I don't do math, I don't understand accounting. And you need to have a basic knowledge of math in order to be an accountant and to be a treasurer. But the treasurer's role is actually one of more of oversight than it would be of doing the day-to-day. Now, if this is a small nonprofit starting up, definitely the treasurer might be doing some of the bookkeeping, might be doing some of the day-to-day functions that an accountant would, writing checks, depositing money that's coming in. But often you're going to have, the treasurer who maybe has check signing capabilities so that they can, if they're, well, you don't want too many overlapping roles, but they might be the second signer on checks over a certain dollar amount if they're the ones that are putting money into the account or running your, say, QuickBooks or your Excel spreadsheet. But they're going to keep track of the financial flow. They want to make sure you're not overspending. They want to make sure you're hitting any targets you might have hit. They might want to be following up if there's money that's supposed to come in. So it can just be simple at the start, simple money in, money out, tracking it on a Excel spreadsheet or on a piece of, grid paper, whatever that looks like for the organization. But really they want to be tracking the financial flow, and ideally they want some way to report this back. So, I've seen simple scratches on the back of a napkin, like we made this much went out. This is how much money we have in the bank. And then of course you get up into your more complex financials. If you're an organization that doesn't have a lot of income and at this point, getting somebody who is able to balance their checkbook and basically can help do the same thing for the organization and have some oversight so that at least two people are looking at the numbers, I think is a great place to go. We can talk more about what happens when it gets more complex, but for the start, that's where I'll leave it. AJ, some of your thoughts?
Yeah, I think you make good points, Mark. I think the one thing I would say is at a small nonprofit, the treasurer might extend, like we've talked about on this program before, kind of the treasurer and the board are an oversight of the organization, and they shouldn't be involved in the day-to-day comings and goings of cash, people, HR, problems, that kind of thing. It's really an oversight of the executive committee and the organization as a whole. And when I mean oversight, I mean, most financial statements that should be going to a board to review should be condensed and as easy to read as possible so everybody can understand. I change my tune when I'm talking about a very small nonprofit and a startup like this one sounds, where it sounds like it's really one person that's investing some of their own money as donations to the organization to get it started. What I would say in that situation, good on you that you have a board, because it's very difficult for small nonprofits like this to find a board. What I would tell your treasurer is really, it is kind of a control piece at this point because you only have one employee. They should be reviewing the bank statement, say, or maybe even signing checks. If you only have one person in the organization, do you really how does that person pay themselves? Are they an employee? Are they making some kind of monthly stipend or payroll? You don't want the person that's paying themselves by writing themselves a check. You need some kind of oversight over this distribution of cash. So having the treasurer step in to be a control piece, it can be a slippery slope. Once you get bigger, they think that that's their responsibility from here on out. But in the beginning, if it's just a small nonprofit like we were talking about, where it's one person, you might want to have that person review bank reconciliations or bank statements and understand, and scrutinize check runs, that kind of thing, as a control piece to the organization, and have what that looks like. And I've been a part of a board where that's the role of the treasurer because it was a very small organization.
Yeah, AJ, and I'm going to just jump in here while you're saying that control piece. The other side of that is don't give the treasurer too much power, right? They should be overseeing the money, but they really shouldn't be making the financial decisions, especially not in a vacuum. They can bring suggestions to the rest of the board, but they shouldn't be controlling the money and then be the sole decision maker on the money, because then that's a slippery slope. That's where fraud can enter into the picture.
Right. Yeah, you really want them to act as a control piece to prevent fraud, not be in the position of writing themselves checks or in the day-to-day thing. They may sign checks, doing a check run sign, but you don't want them, paying for expenses themselves or deciding where money's to be used. Really involving them as a control piece is, I think, the best thing. And having financial oversight of the organization, making sure that money coming in is being spent appropriately on the right, kind of programs and stuff in the beginning. Once you get an accountant, they can do more of that work, or you get to a level where you have a person that's in an accounting staff role or maintaining the books and records of the organization. But in the absence of that, I think the treasurer role probably rolls into that kind of thing. And they don't necessarily need to be an accountant. They just, maybe need some financial training. So, and anybody that's a treasurer doesn't need to be an accountant or a banker, although it's preferable. But you got what you got. And so there are free online learning things on how, nonprofit accounting works. There's basic financial statement and dual entry accounting and how that works. So I think bringing yourself up to speed a little bit on that stuff. You don't need to be by no means an expert in it, but understanding the flow of money through the balance sheet and income statement, statement of financial position, and statement of financial activity, if we're being fancy. But understanding how that works, I think, would go a long way in a treasurer understanding the financial health of the organization.
Yeah, and maybe in a future episode, AJ, we can look at what it looks like to try to find a treasurer for a mid-sized or even a larger organization, because treasurers come and go as well, and the ones for more complex organizations are even trickier to find. So
One thing you can't go wrong with is kind of writing all this stuff down and what responsibilities are and documenting that. I think, clarity is, great. And when somebody's just kind of left to their own devices or not understanding what their role is, really honing in and kind of assigning job duties or board duties goes a long way in making people understand what they're there to do. So.
Right on. Well, I think that brings us to the close of another episode of Profitless on Purpose. We really appreciate you joining us this week and every week here on the podcast. You can find us on YouTube, of course, and through any of your podcast apps. And you can reach out to us either by putting a comment in the YouTube or tweeting at ProfitlessPod. Man, I should have made that easier because it's so hard to say every week. But anyway, on behalf of AJ and myself, thanks so much for joining us, and we'll see you next time.
Thanks, everybody.